Hey everyone, it's Mike Bonn with the Cash Flow Company. Today we're going to go over DSCR ratios, knowing what you need in rents to make a DSCR loan work. So first of all, let's go through again DSCR ratios. All it is really the break-even point. A DSCR ratio of 1 means your expenses, which when they count expenses, it's mortgage payments, it's taxes, it's insurance. If you have HOA or flood insurance, you add up all those numbers, you compare it to your rents. As long as they equal, which means you break even, your DSCR ratio is 1 because they're 1 to 1. Now, just like you, all lenders would like you to actually make a little bit more profit, a little cash flow. So they like that DSCR ratio to be even higher than 1. So like maybe 1.25, meaning 25% higher than your expenses. Remember, you're in this to make money. That's what investing is all about. So DSCR ratios of 1 will get you a loan. It'll break even, so you're not going to lose any money. But just like you, the lenders want to see something like 1.25 or 125% of your expenses going into your coffer. So you are making 25% more, meaning you're putting more money in your pocket, meaning the property is cash flowing, and the lenders love that just like you. The easiest way to understand what rents you need is look at all your expenses, look at your purchase price, and let's go through an example just so you can put those numbers together. As always, take this, practice it, run through these numbers just so you know when you're looking at properties, will it break even? Will it make money? Looking not only at the taxes, insurance, HOA, and flood, but what's your mortgage payment going to be? And then comparing that to the rents, just so you're going to cash flow, or at least positively cash flow, to get a better loan and to put more money in your pocket. So here's an example. Let's look at how we figure out what rents we need when we're looking at least breaking even on a DSCR. Let's start out with what our fixed costs are, because these are things you should be able to look at for most properties, or at least estimate. Number one on the fixed cost is what is your taxes. So let's look at an example where the taxes are $1,200 a year, or divide that by 12 and you have $100 per month. Also property insurance. In this example, we're going to pick and look at $1,800 a year or $150 per month for this property. Lastly, in this property, we're going to have flood insurance. No HOA, but flood insurance. So that's $2,400 a year or $200 a month. So what you see is every month for your expenses, you're going to have $100, $150, or $200, or $450 each month for expenses before your mortgage payment. So in this case, when we're looking at a property, we're going to start with our fixed costs, which are our taxes, insurance, and flood, because those are not going to change depending on your loan amount for this particular property. Now, you can put more than 20% down, 30% down. In this case, we're going to look at a 20% purchase just so we could go back and calculate, once again, how much we need in rents to break even. Now we have our fixed costs, which we figured out with taxes, insurance, and flood of $450. Now let's look at an example of a purchase price of $250,000. And we're going to put down 20%, meaning we're going to put down 20% of the $250 or $50,000, leaving us a loan example of $200,000. Now we know our fixed costs and we know our loan amount. Now we call around, we find out that currently we could get approved for a fixed rate DSCR at 8.5%. Now we want to figure out our payments. We know it's $200,000. We know it's 8.5. We need to know our payments so we can figure out that break-even price or what our rents need to be. I go to a site like calculator.net, pick the amortization calculator, then I put in the amortization calculator the $200,000 for the loan amount. I changed it to a 30-year fix because that's what we're looking at, and put an interest rate in this case of 8.5%. What that does is now it calculates the PI, the principal and interest that I'm going to pay on this mortgage. And I come up with a payment of $1,538 approximately. It's just a little under that. Now I know all my expenses. I have the $450 for my fixed costs, taxes, insurance, and in this case flood insurance, and my mortgage payment of the $1,538. As I mentioned, we know our fixed cost. We know our payment now is $1,538. We add those two together and we come up with a total of $1,988. Now we know what our rents have to be to at least break even to get our DSCR ratio 1 to 1. So a DSCR ratio of 1 means your rents equal your expenses. As I mentioned before, that's great. It'll get you qualified. You'll get that 1 ratio, which means you get the loan. But it doesn't mean you're going to cash flow, because if your rents equal your expenses, you're not making any money. What you really want to see, and so do the lenders as I mentioned before, is a ratio higher than 1. Meaning, if your costs are $1,988, you want to see rents that are greater than that. Let's just say they want a DSCR ratio, or you do, of 1.25. What you do is you take your rent, the $1,988, and you times it by, take out a calculator, times by 1.25, and you get the ratio or the rents that you will need with the expenses of $1,988 to hit a DSCR ratio of 1.25, or a 25% profit margin in your case, because that's what's going to go into your pocket. Just to finish it out, the 1988 times 1.25 is just a little under $2,500 in rent. So you'd go to Zillow, you go to rents.com, you go to wherever it is that you could actually look up and find statistics for rents in that area, and you'd want it to be at least the 1988. But if you want it to be at 1.25, you're going to have to be close to that $2,500 mark, or in this case, $2,485 is a DSCR ratio 1.25. So DSCR ratios, once again, you need a 1-to-1, meaning your expenses equal your rents. Easiest way to do that, does it break even? But none of us are in this just to break even. We want to actually make some money. Now, this is good practice to run through, as you look at properties, just run through all the numbers so you get used to it. Get in the taxes, the insurance, figure out what those are. Look at where the rents are in the market and see if they actually break even. I'll do another video where I actually have the rents and we go back and we figure out exactly what the most we could pay for a property. If you want to run these numbers with a calculator, go to thecashflowcompany.com, download the DSCR calculator for free. And if you have some numbers you want us to run or help you with, or just diagnose, jump in and see what they are, email us at info@thecashflowcompany.com. We'd be glad to help you with any deal or a deal you're looking at putting a bid on. Now, if you want to keep the money train rolling, we'll see you on the next video.